Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
All right. Hey. Welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future. I am Austin Wilson, research analyst at Hicks & Zerker Capital Management.
And I'm Josh Robb, Director of Wealth Management at Hicks & Zerker Capital Management.
Yes, you are.
Yes. Austin, how can people help us grow this podcast?
Well, you're probably listening to this on a Thursday, which means the episode just dropped.
Yep.
And it means you're probably subscribed.
Yep.
But if you're not, you probably should be subscribed so you get every episode every single Thursday when it comes out.
That's right.
Comes out and it's hot. So you
First to listen.
First to listen. That's right. So we would love it if you would subscribe if you're not, and we would also love it if you would leave us a review on Apple Podcasts, Google Podcasts, Spotify, wherever you listen to it. Just leave us a nice review. We wouldn't complain if it was 5 stars because we feel like we give you 5-star information here. So today.
Yes. What are we talking about?
I'm excited about this episode today because this is something I am very passionate about. So today we are talking about why we love
Yep.
dividend-growing stocks.
Yes. It's like you're a gardener and you got your green thumb and you have these reproducing plants that are perennials.
They're perennials.
That's what they
annuals.
are. Not annuals. You don't have to put them back in because they're providing you something over and over and over.
Over and over. So I guess as a matter of background, we should probably say that dividends are cash payments from a company or a publicly traded company in this instance here to shareholders.
Yep.
And this is excess cash that they have left over after fulfilling all of their other obligations. So this is like if you have a share of Apple, the largest American stock in the world now. Saudi Aramco took it over in terms of the world because of all the oil. But anyway, you own a share of Apple stock. You get a couple bucks 4 times a year.
Yep.
Not even that. That's a hypothetical example. But you get some cash into your investment account a couple times a year from Apple. That would be a dividend. So you are receiving cash from the company, and they do this in America typically on a quarterly basis, most often.
Sometimes
semi-annually, and in Europe it's very popular semi-annually. What we're going to talk about today is companies that are growing their dividends. So that means you get $1 per quarter per share this year. Next year you get $1.05 per quarter per share. And it just increases and increases, and the compounding of that is going to be rather astounding, and we're going to talk about that in a little bit. So that's a little bit of a background.
Yeah. Pause real quick. Side note.
Yeah.
You can give stock as dividends. It's rare. It's a lot easier, cleaner, tax-wise. You see it more often for companies. They give cash.
Yeah.
Then you can do what you want with that. Some have direct reinvestment programs where they give you the cash dividend and it automatically rebuys you new stock.
Yep.
It's great. But there is that caveat. You don't see it. It's rare. They could give you other forms, but cash is the way most often you see dividends paid.
And companies like to give cash back to their shareholders as a reward for holding their stock, for being an owner in the company.
Yep.
They can also return cash to shareholders via share buybacks. And this is something that's been a political hot button for some years now. But what really since the 80s, what companies have been able to do legally is go back and buy back their stock. And theoretically, a company would be wise to do that when they think their stock's undervalued, right?
Yeah.
This is something Buffett's been doing recently with Berkshire Hathaway. But that is the other way that companies can return cash to shareholders, is by actually buying back that share that they own or whatever. So today we're going to focus on dividend paying.
Yes.
Okay, so let's talk about why we love dividend-paying stocks. So number one, I have a few points here. Dividend-paying companies typically, not always, typically have strong fundamentals. Why is that? Well, that is because these companies usually have stable and abundant cash flow from operations. So the money they're bringing in...
You can't give me money unless you have money left over.
And you know where your money's going. You're fulfilling all of your debt obligations and everything. It's very predictable. So that is a sign of a generally pretty mature company.
What you don't want is a company paying you dividends and they have to take debt out to pay the dividend.
Yeah, that's usually not a great thing. Another aspect of that is the fact that earnings are often, not always, growing consistently, which gives management that option to return that excess cash to the shareholders instead of holding it in the business and reinvesting it in projects or whatever, or giving it as, a share buyback, as we mentioned earlier. So usually a sign of decently growing earnings, or earnings growing over a long period of time specifically. There's usually some fluctuation year over year or whatever. Another point is that debt burdens usually, this is a common word here, it's usually manageable so that companies can have confidence in their ability to pay those dividends going forward. So companies, most publicly traded companies, have some debt on their balance sheet. They borrowed money, usually in an effort to borrow it at X percent, and they think they can earn more than that on the project that they're invested in, or on the acquisition they're investing in, or whatever. Usually companies have some debt on their balance sheet. If they pay a dividend, that debt burden's usually manageable enough so that it's not a threat to them being able to pay them. So that's another good point. And as an overarching theme, dividend-paying companies are generally confident in the future direction of their company.
Because if they want to give out their cash, they're confident they probably won't need that cash.
That's exactly right. Yep. So, number 2, as opposed to large share buyback authorizations that we just talked about, that companies really can exercise as they see fit, as long as it's approved by the board, they can use some one quarter, not use some another, and just kind of flex it up and down as they want to use cash. Dividends, on the other hand, those are widely viewed as commitments going forward. So
once you start paying a dividend, analysts, investors expect you to continue.
And if you cut your dividend or you stop paying your dividend, your stock is going to be sold off
like that.
Very, very sharply, because those dividends are therefore built into the stock price as part of what the stock's worth today. All those dividends continuing in the future is built into that price today. So that is very confident in the future of their ability to pay that dividend if they initiate one now. So companies with a history of strong growing dividends are sure they're going to do that going forward. So growing those profits to continue to pay that going forward. The next question you might ask is, Austin, I've heard this term. It sounds like you should be wearing a crown.
Yes.
Rolling around in a carriage.
Yeah.
The term is dividend aristocrat.
Like
and is that
Disney
the movie
Aristocats? Aristocats.
That's not the same.
Well, they're the cats of the aristocrats.
They are. Everybody wants to be a cat.
That's it.
Okay, yeah. It's been a while since I've seen that one.
Good one.
So what is a dividend aristocrat, Austin? Well, a dividend aristocrat is a company in the S&P 500 index.
Yep.
They not only consistently pay a dividend to shareholders, but they annually increase the size of its payout.
Okay. So
And
this
that can
is
just be a penny, but they do increase it every year.
a group of SP 500 companies.
Yep.
Narrow down, they pay a dividend.
Yep.
And then narrow down even farther that they increase that dividend.
For at least 25 years
All right.
straight.
So that's the criteria. So they've
Yep.
25 years of dividend increasing history to be called a dividend aristocrat.
So these companies tend to be large, established companies that generally don't enjoy supercharged growth anymore. So they're usually paying a lot of their excess cash, very stable, in dividends. And they continue to do that year over year over year. So a lot of these companies are more recession-proof. They enjoy some steady profits. They continue to grow their dividend in good times and bad. So if you're a dividend aristocrat today, that means you've increased your dividend every year for 25 years prior to today, which means you are increasing your dividend in 2, 3 bear markets, 4 if you include the one right now. So you got the dot-com bubble, you got 08, 09, you got COVID, and now you're in another one now.
2022.
So you're
Fed interest rate hiking
bear market.
Yeah. That's her official name. I just coined it.
That's the exact one right there. So you've consistently, and a couple of those, 1, 2, 3, maybe 4, each of those pretty much has coincided with either some sort of economic slowdown or a recession. That means that these companies have managed their businesses well.
Yep.
I will point out that there is another level above dividend aristocrats.
Ooh, even fancy.
So this is like you want to put on.
Tell
this
me.
is like
Tell me what they
the
are.
crown jewel of the dividend world, and those are known as dividend kings.
Kings, because the aristocrats, they're just the ruling.
They're just
They're hanging out. They're the affluent people of the dividend-paying world. But then
they
you
report to the dividend kings,
Who are these
which
people?
are firms that have increased their dividends annually for more than 50 years.
50 years.
And that's a very small list.
There's a couple. 3M, 64 years. Coke,
P&G.
60 years. Johnson & Johnson, 59. Lowe's, 59.
All right. So, that's the dividend kings. Number 3 reason we like dividend growing companies is that they are lucrative. It's very good. They're value added for portfolios. Why is that? That is, for one, because dividend growth stocks have been, and when I'm talking about dividend growth stocks, I'm using like the dividend aristocrat index.
Okay.
which is very easy to get data for.
Yes.
And I'm comparing it to growth stocks and value stocks and the S&P 500. Okay. So dividend growth stocks have been some of the least volatile equity investments with a lower annualized standard deviation than other large cap benchmarks. So
you just use a lot of big words there.
this just means that they have less drastic moves. Now
Okay.
that's both up and down,
Up and down.
but less drastic moves in terms of price swings than other large cap companies.
Okay.
So let's put some numbers.
Yes,
So
please
I'm
do.
looking at the 15-year period, which is a pretty good stretch and involves a couple bear markets and
Yep.
everything. This is 2006 to 2021. Okay, the Russell 1000 growth, so growth stocks, like tech stocks, high growth stocks, annualized standard deviation of 20.41%.
Okay.
The S&P 500, very similar to that, 20.37%. Russell 1000 value, so like oil companies, financials, stuff like that, 21.57%.
More volatile.
More volatile.
Crazy.
Yep.
It hurts my head.
The
That's
Dividend
fine. Keep going.
Aristocrats Index.
Yes.
Annualized standard deviation of only 16.01. That's substantially
Yes.
lower than the
Yes.
other peers. Okay, next point. Total returns for dividend growth stocks over long time periods have been between growth-oriented stocks and value-oriented
Okay.
stocks. So if you think of the stock market environment we've been in for some time until recently, it's a very growth-oriented stock market. Growth was what worked. Value was what did not work.
Yep.
The Russell 1000 growth over that same time period returned an annualized 12.54%. The S&P, 8.85%. The Russell 1000 value, 4.59%, so that's low. And the Dividend Aristocrats, 6.52%. So right in between, kind of between growth and value there. So now I'm going to get a little bit more technical, but I'll boil it down to a way we can understand. So risk-adjusted returns, as measured by the Sharpe ratio, have been extremely favorable for dividend growth stocks. So when I'm talking about Sharpe ratio,
Yes.
a good way to think about that, and really all you need to know is higher is better,
Okay.
and it is a way to look at return for a given unit of risk.
So I want like $1 million in this
You want $1
score.
million. One-ish is probably pretty good.
Okay.
Okay, so the Russell 1000 growth over that same time period has given you a Sharpe ratio of 0.77.
Okay. So I'm not looking at $1 million.
Nope.
One.
The S&P 500, 0.62.
Okay.
The Russell 1000 value, 0.45. Dividend Aristocrats, 0.98.
0.98. That's the best of that
This is
group.
the best of that group.
And that's because
Much
their-
less volatile,
their
even though they
total
got a lower
return of
return.
6.52
Yep.
is awesome when you consider they only took 16% standard deviation or
Absolutely.
volatility to get that return.
Absolutely.
Gotcha.
So, Sharpe ratio, very good. So, those are the reasons, a couple of the reasons why we think dividend growth stocks are particularly awesome.
Okay. So that's good history, kind of setting up what dividend growth
We're
stocks
setting
are.
it up.
Gotcha. Now I know what they are. Got a way of tracking it. Dividend aristocrats. That's the way of
Everybody
finding
wants
it.
to be a dividend
I can
aristocrat.
Google that and find those names.
Yep.
Gotcha. Let's take a break. Dad joke.
Bring
Got
it.
one for you. Okay. Did you know that if you delete all the phone numbers in your iPhone, your pictures get blurry? Because the iPhone doesn't have its contacts.
That's funny.
go.
That's funny.
It doesn't have to be
Android
iPhone.
does?
It uses glasses.
Okay, good. That's good.
Had LASIK.
Classic, Josh. Classic. All right. So another thing I wanted to talk about today
Yes,
was
please do.
how dividend reinvestment.
Okay.
So that's when you get that you're owning all those shares of Apple and you get those couple bucks here and there over time. When you take that and you reinvest it into more shares
Yep.
or essentially or into your portfolio, into the market, whatever you want to do, you're reinvesting it. You're not just sitting on the cash. That reinvestment is really key for long-term total returns. Now, total
So-
return is encompassing price
Everything.
return plus dividend return, right?
Yep. So when I get paid that little bit of money from the company, I shouldn't just go out and
Spend it.
splurge on it.
Yeah.
If I want to get really amped up returns on these things,
Yeah, like if you want to
that's what I'm
supercharge
doing.
it,
Okay.
but you're going to reinvest it. So
Okay.
nearly half of an investor's total return can be attributed to reinvested dividends over a 30-year time
Okay.
period.
So like a full working year career.
Yeah. So let's
During my
put
savings
some
years.
let's put some numbers to it.
Yes.
So over a 1-year period, very short term, dividends only represent about 6% of an investor's total return. So that
Okay.
leaves 94% of that return to price. Over a 3-year period, dividends are about 10% of total return, while that's 90% for price. Take it out to 5 years, that's dividends at 15% of total return and 85% price. See the trend we're getting here. 10-year period, dividends 22% of a total return, 78% for price. Over 20 years, Dividends represent 38% of total return, 62% left to price.
Ooh.
Over 30 years, dividends represent 47% of an investor's total return, 53% at price. So about 50-50.
Yeah.
That is crazy. So said another way,
Say that same thing a different way.
an investor who reinvested their dividends would achieve nearly double the total return of an investor who did not reinvest their dividends.
Yep.
So looking at that same 30-year period, let's look at 1 year. So this is ending 12/31.
Okay.
So looking back 1 year, back 3, 5, 10, 20, and 30 years. The prior year, S&P was up 27%. Someone who had reinvested their dividends into the S&P, they were up 29. So not a very big difference.
Yeah.
Over prior 3 years, the S&P was up 90%, while someone who reinvested their dividends was up 100, so 10%. Over 5 years, S&P was up 112. Someone who reinvested their dividends, they were up 132.
Oh, boy.
Over 10 years, the S&P was up 278. Someone who reinvested their dividends, they were up 359.
Pause.
Yeah.
10-year
Yeah.
stock return, if you had dividends, you're up 359% heading into this year. So that 20% correction makes it, I lost all my money.
Of course.
Right.
Yeah.
That's
so
it goes
puts
back
into
to our
perspective.
thing of just perspective
And
of
the fact
why
that we've
investing
had-
long-term matters.
And we've had exceptionally strong stock market returns for years and years and years, fueled by low interest rates and a very easy federal monetary policy.
Yeah. But even
world.
that 10-year period had 2018, which was a 19% drop.
Yep.
2020, which we saw a 34% drop. So it's not without volatility. But
No.
you're right. We did have a good year. But
Ride it out.
360% growth in 10 years.
So let's take it out another 10 years.
Yep.
20 years, the S&P was up 309%. If you reinvested dividends, that was up 501. And over 30-year period ending end of last year, ending in through 2021, the S&P was up 1,043%. So that's what, a 10-bagger.
Yes.
While someone who reinvested their dividends, they were up 1,979%.
Oh, wow.
So almost double.
Wow.
Same kind of thinking. So
That's crazy.
those are some numbers that really make you want to reinvest your dividends.
Yeah.
So speaking of dividends, Josh.
Yes.
There's this other term that I've heard thrown around.
Yep.
And you taught me this many years ago.
Yes.
This is called the Rule of 72, and I think you just made it up, but I think you should explain it.
The Rule of 72 says, at age 72, required distributions are needed out of your port. No, I'm just kidding. That's another 72 rule.
Oh, yeah, we don't want to
Not
talk
that
about
one.
that.
Forget that one. The Rule of 72 actually...
Wake people back up.
Yes. That's a formula, a math rule that stipulates if you are wondering how long will it take for my money to double,
Yep.
and I know what my rate of return is, then I can tell you how many years. Or you could go the other direction. If I know how many years, how much return do I need to double? But the idea is looking at doubling, all right? So there's a whole equation for this, but this is the simplified. I can do this in my head most of the time, or at least on a simple calculator to figure this out. So we use that 72. So first, some history. The Rule of 72 dates back to the year 1494.
That's like Christopher Columbus era.
He's just landed. He's hanging out.
Yeah.
This is Luca Pacioli.
Sounds Italian.
I'm guessing. He referenced this in his comprehensive mathematics book called Summa de Arithmetica.
Good.
I'm not really good at Italian, but that's pretty much as far as I'm going to go. He made no explanation of how this rule
You just
works.
put it in there.
So the thought actually is he took this rule from a pre-existing rule from somewhere else. He didn't come up with this because he wasn't explaining how this whole thing works.
Yeah.
He just said, hey, I know this rule. Let me put it in my book. There's an actual mathematical equation for calculating this. And if you use the Rule of 72, which I'll describe, you get close. I mean, it's rounding, but it's close enough where if you're saying I need to know doubling, it's there.
Yep.
Okay? So the Rule of 72 works like this. You say, okay, I'm going to divide 72 into that rate of return. And so, for instance, the easiest one, the simple one is if I have a 10% return, that's 7.2 years.
Yep.
All right?
72
divided by 10%. All right, we got 7.2 years. So if I have something earning or growing in dividends 10% per year in 7.2 years, I should expect it to double.
Gotcha.
Now, there's a couple caveats to this, which I just learned. I did not even know this.
Yeah.
If you want to be very precise, then
Which we always do.
you only use the Rule of 72 between the range of 6 and 10%.
Huh.
If you want to then make that adjustment to have a calculation be better to the real formula, you add one to the number 72. You add 1 point to the number 72 for every 3 points you get away from 8% threshold.
Really?
That was really weird if I said that and if
Yeah.
you're listening on the podcast. So let me give you an example. If you go up or down from 8%, 3 points, that's when you start adding. So 8 minus 3 is 5.
Yep.
So that's why that's 6 to 10% range. If I am doing 5%, I should actually use 71
Gotcha.
as my factor in there.
Yeah.
Or if I'm using 11%, 8 plus 3, I should use 73.
Huh.
If I'm going to go to 14%, I should be at 74. You see how that works?
It does make sense.
It just gets you closer. I looked up and did the numbers, and high level, you get like you're within the same year. You would have just been off by like 6 months.
Right.
You know, it's not really breaking your formula. But if you want to be more accurate, that's something worth knowing.
That is interesting. So,
one more before we get there.
oh, bring it.
Continuous compounding, which dividends don't have, but if you have an interest rate that's continuously compounding, you actually use 69.3
Instead of 72.
Yeah. There you go.
Of course you would.
Yes.
Why not?
How does this apply to it, though? So if you are, and we know that dividend payers tend to continue to pay their dividend,
Yep.
and the ones that are popular are the ones that are growing their dividend.
Absolutely.
Because you don't want the same dollar amount because of inflation. If you can know or calculate what that anticipated growth rate is, that growth rate could tell you how often your income from that dividend paying stock is going to double. So like you said, if I'm getting $1 per share in dividend payments and it's growing at 10%, how long is it going to take me before I'm getting $2 per share?
7.2 years according to the rule 72.
That's right. So that's a way of just saying, okay, if I'm looking at maybe using dividends to help my income in retirement, I can kind of factor in what will that dividend dollar amount be if I know a annual or average growth rate on those dividend paying stocks.
Awesome.
So that's what you use it for. It's a great way, easy way to calculate that.
Yeah. So the question everyone's asking as they're listening to this right now is,
Yes.
hey, Austin, how the heck could I invest in this trend?
Yes.
And first of all, the two caveats we're going to go
He
ahead
always
and
loves
give is, number one,
Yep.
you might already be.
There's a good chance.
There's a lot of companies who grow their dividends well, who are in the passive indexes. You probably
we
hold in
mentioned a
retirement.
couple of those kings. You're
Absolutely.
not new,
Yeah.
not unknown.
So that's, you may already own some of this.
Yes.
Number two, I'm going to name some tickers, companies, symbols. These are not recommendations. Do your own due diligence. See if it fits your investment philosophy, your risk tolerance. We'll talk to your advisor about them. That's great. So take everything I say with a grain of salt.
Yep.
I will also say that we do actively manage a dividend growth strategy in-house. So that's one of the reasons I'm so passionate about it, because I know so much about it. So if anyone has any questions about that, send us an email for one, or check out the Invest With Us tab on our website. So,
But the things you're going to talk about are not necessarily in our portfolio one way or another.
they might be or they might not be.
Not a recommendation, just some examples.
Absolutely.
There you go.
So, individual stocks. You could obviously buy individual stocks. We mentioned a couple of them before, but these are ones that we haven't mentioned. But I looked these up. So, Visa, the credit card issuer, they have a low yield. It's less than 1%, but they have a high dividend growth rate. It's actually over 14% annually over 1, 3, and 5 years.
Wow.
So that's a dividend growth
Not
stock.
bad.
Bank of America is another one. They have a mediocre yield. It's decent. It's like 2.5%, something like that. But they've got more than an 11% growth rate
Nice.
over 1, 3, and 5 years.
Now,
so those are some dividend growth stocks.
With individual stocks, I mentioned before, there's reinvestment programs.
Yeah.
Some have direct investment programs with the company where you aren't.
a drip.
Yes. And that's the acronym for it. The idea there is it's cost saving because you have lower costs for setting this up. They automatically reinvest those dividends for you. You avoid like those transaction fees. It was really a bigger deal years ago when there was individual transaction costs that were in the 20s,
Right.
$20 range, right? Where, boy, for me to buy these individual stocks every time is going to be expensive. So these companies set up this idea that, hey, you want to be a shareholder of ours? Let's help you out. Low cost, held directly. It's very easy. Now that the low trading costs across
Much
the board,
less
most
popular,
custodians
I'm sure, yeah.
don't cause it's a lot less needed because you can have stuff in one spot. But those are out there for people that are interested. They're still there.
And you can most custodians, you can set what to do with
Yes.
your dividends.
And tell them to
And you can
rebuy it.
tell them to reinvest them into the security or not.
Yes.
So those are options you have. Okay, so those were individual stocks,
Yep.
ETFs. Josh, you love ETFs.
Yes, I hope there's a good one.
There might be some tickers you might like.
I hope so.
So one is, again, no recommendations here, the iShares Core Dividend Growth ETF.
Okay.
Ticker, DGRO.
Okay. Dividend
Like
growth.
dividend,
Yeah. Okay.
I see it. Another one is the ProShares S&P 500 dividends or Dividend Aristocrats.
The aristocrats.
Ticker NOBL.
Noble.
Like
there you
aristocrats.
go.
Okay, that's pretty clever.
Someone put some time in that
there
one.
are some mutual funds that are focused on this as well. Again, no recommendations, but one is the Vanguard Dividend Growth Fund, ticker VDIGX. Not a great ticker.
Well, we've talked about
why
funds
mutual
have to end
funds.
in X and
Exactly.
boring.
And they've always got to be 5 letters, and there's multiple share classes, and it's a pain. Another is the T. Rowe Price Dividend Growth Fund, and that's ticker PRDGX.
Okay.
So those are some options just to get the wheels turning. Again, do your own due diligence, talk to your advisor, ask us if there's any questions, but those are some ways to get exposure to dividend growth in your portfolio that may be different than you already have, but you probably already have some.
Like you said, you probably already have it in that. If you own the SP 500 index, there are
absolutely.
dividend payers in there.
Yeah.
So if you're a globally diversified portfolio, you probably have dividend payers in there somewhere.
Yep, absolutely. So that's why I love dividend growth stocks in a nutshell. Josh.
There you go.
How do you feel about
I
them?
appreciate them as well.
That's good.
And again, going back to that diversified portfolio, you saw the variation in returns, and there's going to be years where dividend payers do well. This year is one of those years where more value-oriented, more stable companies have outperformed. There's other years where growth-oriented outperform. So again, it comes back to a diversified portfolio. But if you are looking or needing income from your portfolio, man, dividends are nice.
They are.
Because we didn't even get to the tax structure, but there's different types of dividends. A lot of them are qualified, which is just a better tax rate.
Yep.
So, there's some really positive ways to earn some income from those stocks while you're holding them.
Absolutely. Well, that's dividend growth. Again, please let us know if you have any questions and share this episode if you enjoyed it with friends and family, or if you have someone just asking you, man, dividend growth, what is that all about? We would love to be able to help them. As always, send us any questions, ideas, whatever, comments to hello@theinvesteddads.com. And until next Thursday, have a great week.
All right. See you later.
Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to dividend-growers.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.